You take those shares and you write a similar contract to what we just did, but that would take the shares away from you and you could collect more money and you could get more money, throw back to In Living Color. Welcome back to Make a Mill, the channel where we all want to make it to 7 figures. So let's get started on that journey right now. Today, I want to do some live stock trading with you. I want to explain a little bit about what it means to buy a stock without buying the stock. What does that mean? We'll jump into the trade in a second here. The market's open, so I want to hit this trade real quick before the prices change. But once you've chosen a company like I have, WBD, Warner Brothers Discovery, that's fundamental analysis. That's what company am I going to buy? Why am I going to buy it? What price am I willing to pay for it? That's one sort of research you can do. Let's do the trade. And what I want to do is, okay, we have our stock, we have our price. Now what do we want to do? We want to go in the market and we want to buy something. Or in this case, we're going to sell something. So I'm going to explain it right now. What is this insanity, this craziness? Okay, I've chosen the company and I've chosen the price, right? That's fundamental analysis. That's okay. I have chosen Warner Brothers Discovery, for example, at $6 a share. And we could go into all the reasons why that is. And I'd like to hear in the chat, what do you all think about Warner Brothers? I think is valued at $20 billion right now, market capitalization. I think that's way undervalued for the media and IP assets and infrastructure that they own when you read their balance sheet, et cetera. So that's my fundamental analysis. That I'm not showing you that. I'm just telling you, I'm summarizing that for you. But now, okay, I have that information. How do I make money off it? Okay, I can, if I go look at now, the price of Warner Brothers is $8 a share. I want to buy it at $6. That's my analysis told me. I don't want to buy it at $8. I don't want to wait. How do I make money in the meantime? How do I simulate or synthesize the position of buying the stock without buying the stock? And I've used this strategy to make money for years and years without ever owning a share of, for example, Apple stock or many other companies that I'll just sell puts. I'll just write contracts like this and they'll never execute, or I'll buy to close them and I'll make profit and I'll never own a share and I'll sit there and profit for years. You can buy to open or that's when you're buying options. So we're on the sell side. So we're selling to open. You can do a put or a call, right? I'm not going to talk about calls today. We're just going to talk about puts and what that means. And we have a sell to open. And that's how you open the contract. And to close the contract, you have to pay. And when you sell to open, you get some premium. You get some money here. Per contract, so 18 cents per. I'll explain what all the numbers mean in a second. Stick with it. And then you buy to close. That's how you buy it back. So you have quantity. That's the number. So I'm going to do 50 contracts. Okay. And each contract is 100 shares. So what a put means, what this means is the buyer of the put has the right to put shares in my hand. That's what it means. Put, right? So put the shares in my hand. That's what put means. Call means call it away. That's when you have the shares, you do covered call strategy, and we'll do a different video about that. But this is a cash secured put strategy. You can use margin and leverage with this, but I would recommend starting with not writing contracts more than the cash you have, at least starting out. We have an expiration date. So when we buy the shares, for example, if we bought those shares at $8, we could only buy a certain number with $100 or whatever. We could only buy a certain numbers of shares. We can buy more with 6, right? That's kind of part of the reason to do this, because you can buy stock for cheaper than what it is now. So that's what the strike price means. That's the price that you're going to buy it at. The expiration is the date at which that you'll have to buy it. Now, stay with me here. There's 2 different types of option contracts. There's American and European. European contracts, they expire only on this day. So you choose this day and the person on the other side cannot decide to close the position, okay? On the American style of options, WBD, you can close it early. What this expiration date means that I'm writing is that says, hey, I am going to put this contract into the market. And it might not get filled. 9 times out of 10, they don't. And I'll just take the price down. And many times they don't get filled. This means that, hey, if the price of Warner Brothers Discovery stock goes below $6 by December 20, then I've got to buy the shares. Let's say it's at $5 a share. I got to buy them at $6. So I'm out that dollar. So then the person who bought the put gets that dollar of profit, less transaction fees and frictional costs. If you think about it, this is basically owning a stock without owning it. One huge caveat is doing this, you don't collect a dividend. they don't pay a dividend. But if they happen to have paid a dividend, I would not have collected on that. And that is one thing to put into your calculations and considerations if you're interested in dividend income, that you might want to just buy the shares outright for the income. But if you have a long time horizon, you might want to look at this to generate extra income on your cash and on your assets. And let's go. Let's do this trade. All right, I talked enough. I don't want these rates to change on me. Okay, so I'll just talk you through it. So there's a limit. So what I'm saying is, hey, I'm putting 30 grand on the line. So just do the math. 50 times 100, that's 500 shares. That's what I'm betting. I'm saying, hey, I'll have to buy 500 shares at $6 a share. Let's see. I'll start it at 17. This is a bid ask spread. So this is kind of an illiquid one. Like you really want a bid ask spread that's like 15, 16 when you're buying stock. It's more like that. But with the options, you'll see them much further apart, and you just get used to that. Options are a little less liquid than stocks. It's part of the game, but it's a beautiful game, baby. So let's place this order. Limit at 17, and I would be getting $820 some odd dollars. I don't think it's going to fill. I'm just showing you the process that I do. I just want to show you how this sausage is made. And the funds required is not the full 30 grand because I do have a margin account. So it's only 8 grand. Let's place this order. Got it. And let's go over to the order status, and it's open. So it didn't get filled. And I told you that earlier, that 9 times out of 10, you don't get filled. And I don't like to get filled right away because I feel like maybe I got the price wrong or something. So let's change it to 16 and see what happens. And if it gets filled, I'm just going to pause this because there's some accounting I have to do when I do trades, and I have to kind of capture it in real time. So let me place this order, and put has been filled. So I'll be right back. So we got a minus 50 here. So that means, because I'm selling, so that's, I showed you in the beginning, we have a buy to close. So I collected about 700. Now that's after transaction fees and costs. So I sold for 16. If you look at executed here for 16, but my average price is 15 after the cost, right? So that's how it goes. To buy this back, we want to pay less than what we got. So if I won't show you in my bank account, but just trust me that I got $732.42 more in my bank account just in this second, right in that contract. So like, it's kind of like printing money, but you have to think of it like this. You're also creating this liability. You do get the cash flow up front, which is super sweet, especially when you're writing bigger contracts. You get like 1,000 or 2 grand if you're writing a bit more contracts. Of course, that pushes the transaction fees higher the more contracts you write, because I think it's 50 or 60 cents per contract. So that starts to add up. So that's also a consideration. The stock itself, if it trades at a higher price, if it trades at 200 a share versus $2 a share, you're going to be paying a lot more in transaction fees on penny stocks than on $200 a share stocks, like Tesla or Amazon or something with a high share price. So share price actually kind of matters in options because they constrain us to this 100 shares per contract thing. Let's dive into the probabilities that I use to assess these things. So here we are in the Charles Schwab platform. As you can see, I've loaded it with my WBD contract here. And as you can see, options contracts kind of have these chains that go by date because timing is important. Timing is everything when it comes to options trading. And I would liken options trading more to swing trading. So here's the contract I just wrote. You'll see that it's already bumped up about $1 above what I paid. About 17 is the average, although whether that 17 will get filled is questionable. We come to some key metrics, some KPIs. We have a probability in the money. That's the probability that the contract will get executed. Now that is no bueno for me. That means I lose. I have to buy shares below $6, but I have to pay $6. So the share price could be at $4 here, and I would still have to pay $6. I'm basically insuring the person who has the shares. I'm insuring their stock. I think of this as a business of insurance where I insure your stock that it won't go below a certain level. So if you want to insure your shares that they won't go below $6, buy this contract, and I am selling it. So that's what this means, kind of. And probability of touch is usually about double. Rule of thumb, you'll notice it's about double no matter what the contract. It's about double the probability of in the money. And that's just the probability that at any given moment during the lifetime of the contract. So at any day between now up until December 20th here. And that's just the probability that the share price here, see it's $8 now, that it would actually reach that level, that it would touch 6 or below. So we have a 37% chance, so closer to a 40%, so more like a 2 in 5 chance. So that's how I use probabilities. And this is a way that you can tailor your risk to suit your preferences and your portfolios. A lot of people, a lot of times when I talk to them about options trading and stocks, they say, hey, that's risky. Isn't that, I don't know, that's too dangerous for me. And I say, it's the safest thing possible, actually. You can literally adjust your risk right here. You can write and you can write the flip contract of what I just wrote. You can write an in the money put that's already above the strike. So it's at 8 and you're writing contract at 10. That's really dangerous. It's an 8 out of 10 chance that you'll lose and a 2 in 10 chance you'll win. So you can calibrate your risk. You can, if you're real conservative, you can collect almost no premium for almost very little risk, very little risk. And what I love about the options trading game is that even when you lose, you win. And that's the kind of game I like to play. Let me explain what I mean by that. Hypothetical scenario analysis. On December 20, the price of Warner Brothers sank from $8 to $5 a share. Oh, that's a sad day for me. I got to buy shares at $6. So that dollar of profit per share, and I wrote 50 contracts, so that's about $500. You don't really lose, because what happens is you acquire the shares. And as we all know, you don't have to sell the shares. You have a loss on paper. So I'm down $50 or $500 immediately on day one in the shares that I own. That's not cool. That kind of sucks. But I didn't actually lose money. Like, I don't report to the IRS or the government that I lost money, because I didn't lose money. I just acquired an asset that's worth a little bit less than what it should be worth today. It's not that bad. You can hold on to it. And what you can do then, and what I do a lot all the time, is the wheel strategy, they call it. You basically turn around and write a covered call on the position. So what that means, and maybe I'll cover that in the next video, you take those shares and you write a similar contract to what we just did, but that would take the shares away from you, and you could collect more money, and you could get more money throw back to in living color. So I hope this was informative. Let me know in the comments any questions and concerns you guys have. Till next time, please subscribe. Please let me know what you think. Bye, baby.